Inflation is often viewed negatively, associated with rising prices, diminishing purchasing power, and economic instability. However, it plays a crucial role in fostering economic growth, ensuring financial stability, and maintaining a healthy economic environment. This article delves into the complexities of inflation, explaining its mechanisms, benefits, and implications. By exploring 5 key sections: understanding inflation, the causes of inflation, the benefits of moderate inflation, the risks of deflation, and managing inflation, this piece aims to provide a comprehensive view of why inflation is not only inevitable, but also necessary for a thriving economy. Inflation refers to the general increase in prices of goods and services in an economy over a period of time, leading to a decrease in the purchasing power of money. Economists measure inflation using various indices, with the Consumer Price Index, CPI, and the Producer Price Index, PPI, being the most common. 1. Demand pull inflation. This occurs when demand for goods and services exceeds supply, prompting businesses to raise prices. It often results from increased consumer spending, government expenditure, or investment. 2. Cost push inflation. This arises when the costs of production increase, leading producers to pass these costs on to consumers. Factors contributing to cost push inflation include rising wages, increased raw material prices, or supply chain disruptions. 3. Built-in inflation. This type of inflation results from the adaptive expectations of businesses and workers. As workers demand higher wages to keep up with rising living costs, businesses increase prices to maintain profit margins, perpetuating a cycle of inflation. Inflation is typically measured on an annual basis, and central banks closely monitor these rates to gauge the health of the economy. A moderate inflation rate of around 2% is generally considered healthy for economic growth, indicating that prices are rising at a manageable pace. Several factors contribute to inflation, and understanding these causes is essential for grasping why it can be beneficial for the economy. Central banks control the money supply and interest rates in an economy. When a central bank increases the money supply or lowers interest rates, borrowing becomes cheaper. This can lead to increased consumer spending and business investment, thereby driving demand and subsequently prices upward. Government spending also plays a significant role in inflation. When a government increases its expenditure, particularly during economic downturns, it can stimulate demand, leading to inflation. For instance, stimulus packages during recessions aim to boost consumption and investment, which can lead to rising prices. Events such as natural disasters, geopolitical tensions, or pandemics can disrupt supply chains, leading to shortages of goods and services. These shortages can create upward pressure on prices, resulting in inflation. Global economic conditions also influence domestic inflation. For example, rising oil prices due to geopolitical tensions can increase transportation and production costs, leading to higher prices across various sectors. While high inflation can erode purchasing power and create uncertainty, moderate inflation offers several benefits that are crucial for economic growth. When prices are expected to rise, consumers are more likely to spend rather than save. This increased spending drives demand for goods and services, stimulating economic activity. Similarly, businesses are incentivized to invest in new projects and expansion, anticipating higher returns on investment in an inflationary environment. Inflation can benefit borrowers by reducing the real value of debt. As prices rise, the amount owed becomes less burdensome in real terms, allowing borrowers to pay off debts with cheaper dollars in the future. This can encourage consumer borrowing and spending, further fueling economic growth. In a moderate inflation environment, employers are often compelled to raise wages to keep pace with rising living costs. This wage growth helps improve the standard of living for workers and increases disposable income, further driving consumption. In a growing economy, prices of certain goods and services may need to rise to reflect changes in supply and demand dynamics. Moderate inflation allows for these necessary adjustments without causing severe economic disruptions. It enables businesses to manage costs and adapt to market conditions effectively. While inflation has its advantages, deflation and overall decrease in prices poses significant risks to an economy. Understanding these risks highlights the importance of maintaining a healthy inflation rate. When consumers anticipate falling prices, they may delay purchases, hoping to buy at a lower price in the future. This can lead to decreased demand, causing businesses to cut production and, in turn, leading to layoffs and higher unemployment rates. Deflation increases the real value of debt, making it more difficult for borrowers to repay loans. As incomes fall and businesses struggle, defaults can rise, leading to financial instability and a potential economic crisis. Deflation can trap an economy in a downward spiral. Decreased spending leads to lower production, which results in layoffs and decreased income. This cycle can create prolonged periods of economic stagnation, as seen during the Great Depression. Given the dual nature of inflation, its benefits and potential downsides, effective management is crucial for maintaining economic stability. Central banks and policymakers play a vital role in achieving this balance. Central banks use various tools to manage inflation, including interest rate adjustments and open market operations. By raising interest rates, central banks can curb excessive spending and borrowing, thus controlling inflation. Conversely, lowering rates can stimulate economic activity during periods of low inflation or deflation. Governments can also influence inflation through fiscal policies. By adjusting taxation and government spending, they can either stimulate demand to avoid deflation or cool down an overheating economy to prevent excessive inflation. Many central banks adopt an inflation-targeting framework, aiming for a specific inflation rate. This approach provides a clear benchmark for monetary policy, helping to anchor expectations and enhance economic stability. Investing in supply chain resilience can mitigate the impact of supply-side shocks that contribute to inflation. By enhancing logistics and diversifying supply sources, businesses can reduce vulnerabilities that lead to price spikes. Inflation is often perceived negatively, yet it plays an indispensable role in the economy. While high inflation can lead to economic instability, moderate inflation fosters growth, encourages spending and investment, reduces the real burden of debt, and supports wage growth. Understanding the causes and benefits of inflation is essential for policymakers and economists in crafting strategies that balance economic growth and price stability. By managing inflation effectively, we can ensure a thriving economic environment that benefits everyone. Recognizing inflation as a necessary component of a healthy economy allows us to appreciate its role in facilitating growth and stability in an ever-changing world.